Hi there. This is the last video for chapter 6. Okay, we so far have seen the costing of inventory and reporting of inventories. But the last topic in chapter 6 is analysis of inventory. Okay, for the analysis, the textbook introduces two numbers, which one is inventory turnover, and the other is days in inventory. Inventory turnover is defined as cost of goods sold divided by average inventory. And average inventory is defined beginning inventory plus ending inventory divided by 2. Okay? And then days in inventory is very simple, 365 days divided by the inventory turnover. Okay, a tip in memorizing all these formulas is there are multiple, like 3 turnovers that you will study in each of the later chapters, in this, including this chapter. All of the turnovers are defined as either sales or cost of goods sold divided by the thing. Again, something turnover is defined as either sales or cost of goods sold divided by average the something. Okay. Then what's our choice between sales and cost of goods sold? It should be the one that is journalized together with the thing. You remember that last class, in the last chapter, we talked about merchandise operation, merchandising companies accounting, and there we saw that when cost of goods sold is journalized, together with it, you credit inventory. So the increase in cost of goods sold is closely related to the reduction in inventory. That's the reason why cost of goods sold is divided by, cost of goods sold instead of sales is divided by inventory. And then days is always defined as 365 divided by turnover. Let's make a just hypothetical case that your days in turnover was calculated as 30 days in days in 2020, and it became 50 days in 2021. What does it mean? Your inventory is getting longer and longer staying in your warehouse. Do you want your inventory to stay longer and longer in your warehouse? Do you want an iPhone to stay? Does an Apple Store shop manager want an iPhone to stay longer and longer in the Apple Store? No, you want the iPhones to be sold like pancakes, right? The shorter, the better. If the days is increasing, then it's not good for your business, right? Let's have a look at the real world numbers. Where do you find the real world numbers? As we've discussed in the last videos, you can find the real world, the original raw data of the real world numbers are either from SEC website, the EDGA, or the company's own website. Okay. But if you can rely on some other data sources which already have calculated everything for you, then it'll be the best, like Bloomberg Terminal. Okay, I just accessed to the Bloomberg Terminal for your convenience, so you don't have to. And when you log in, you will see most likely a screen like this. Okay, let's compare 2 companies' cases. One, Ford. If you want to find some information about Ford, then in the status bar, you just type in the company's ticker. Ford's ticker is F. If you type in F, you will see different data fields, including Ford, which is again F, US equity, which is Ford Motors common shares. Okay, I will click this one. And then we are looking for the ratios, the inventory turnover and days in inventory. You can find that kind of data from financial analysis. Click it. Then, can I make it larger? Oh, this is better, right? Then you can see that one of the tabs is ratios. Let's click it. And then here you have multiple different levels, so different types of ratios that Bloomberg calculates for you. Let's click working capital. Then you can see that Bloomberg conveniently calculated multiple years, 2011 to 2020. Inventory turnover and days inventory outstanding, DIO, right? Having a looking at these numbers is cool, but better is visualization, right? We are living in the age of data analytics. How do we visualize this data? Let's export these numbers into on Excel. And let's do the same thing for GM. You type in GM, and you can see GM US equity is here. Click it. Choose financial analysis. Choose ratios. Select working capital. And then the similar table is here. Let's export it. Excel current template. Then we have two companies data like this. This is Bloomberg Terminal, what Bloomberg Terminal shows you. I want to download everything in my local drive. What I will do is just copy and paste. Copy the header and then paste onto my local drive Excel spreadsheet. And then let's copy only days inventory outstanding, DIO. And these are for Ford. So I will write it, Ford. And then we can find GM's data here. GM's data here, GM. And let's draw a graph chart. Insert here, scatter chart, and nice and quick, we draw a graph. What do you see? Oh, Ford's days in inventory is slightly over the 10 years, past 10 years. It is increasing from 18 to 32, about twice it has been increased. Then is there any industry level wide increase in days in inventory? Right? Let's compare Ford's data with GM's. Indeed, GM's there was some fluctuation in like 2005, right? But except for 2005, it is rather stable. Or even it has been shrunken, right? Except for the last 2 years, especially this year is heavily affected by COVID. So let's forget about this data. Okay? So quite stable GM's is, or it has been shrunken from like 37 to, oh, whoa, not shrunken, not really shrunken. Except for this one, right? Except for this one. It has been shrunken from 37 to 33. But Ford, it has been increased slightly. But the trend is trend. In terms of levels, well, GM's was much higher than Ford, right? So in terms of inventory, Ford was doing much better than GM, but it's the days in inventory is ticking up to a close level to similar level to for GM, right? What's going on? Something's off with Ford, right? You should dig into more to make a good investment decision, right? Okay, that's it for today, for today's video, and see you in a video that discusses chapter 7, chapter 8. Okay? See you there.